Welcome to the deep dive. If you're joining us today, you are exactly where you need to be. You, the learner, the person who really wants the shortcut to being comprehensively informed without, having to manually sift through a mountain of white papers and market reports.
And there is definitely a mountain of them today.
There is. That is our mission today. We have compiled a massive stack of recent market research, institutional outlooks, deep dive articles about a technology layer that has just radically transformed over the past few years. And we're going to extract the absolute most important mechanics for you.
Yeah, we're pulling from a very robust set of data today. We are examining market size estimates from groups like Collection, institutional adoption metrics from Grayscale, CoinDesk, actionable blueprints for digital creators, and even concrete case studies of this architecture operating in the real world.
Which is great because it provides a striking look at an industry that has essentially ripped up its own foundation and rebuilt its identity from scratch. Let's acknowledge the date for a second just to set the stage. Today is Friday, March 6, 2026. I want you to take a mental time machine with me back to the wild days of 2021, 2022, maybe even early 2023. When you thought about tokenized digital assets back then, your mind probably went straight to the chaos.
Oh, absolutely. The cartoon apes, the pixelated avatars.
Exactly. Late night speculative flipping on secondary markets. It was loud, it was abrasive, and for anyone trying to analyze the underlying architecture, it was deeply confusing because the noise just completely drowned out the signal.
That era was defined almost entirely by a speculative frenzy. I mean, the underlying technology was being utilized, but it was being utilized primarily as a digital casino rather than a functional software tool.
Right, a casino.
Yeah, the actual utility of an immutable, decentralized ledger was completely overshadowed by just the sheer volume of capital-chasing novelty.
Okay, let's unpack this, because here's the big reveal, and honestly the entire reason we're doing this deep dive today. The conversation right now in 2026 is completely unrecognizable from that era.
Totally different landscape.
The dust hasn't just settled. The entire landscape has been paved over. The hype machine burned itself out, and what is left standing is actually incredibly powerful infrastructure.
Which brings us to the core question of today's deep dive.
The defining metric.
Yes, the defining metric that now separates the successful digital asset projects from the absolute failures. The question is simply this: what problem does this token solve after the mint?
And that question completely reframes the industry. We're observing the natural maturation cycle of disruptive technology here.
How so?
Well, historically, profound technological shifts almost always begin with a highly visible, incredibly volatile novelty phase. People test the absolute limits of the new capability. Then, if the technology possesses genuine utility, the speculative froth boils off.
The hype dies down.
Exactly. And the architecture quietly transitions into essential, almost invisible background infrastructure.
We have a huge agenda to get through today to show you exactly how that is happening. We're going to explore this massive shift from flashy collectibles to invisible infrastructure. The boring stuff that actually works.
Right. We'll examine the current market valuations, which reveal a sector that has matured into a heavy-hitting industry. We will walk you through 5 highly practical, real-world use cases operating at scale right now.
Not theoretical, but actual scale.
We are going to break down the user experience revolution that is finally fixing those clunky, frustrating onboarding processes from the early days. We'll analyze an actionable playbook for digital creators, and we will wrap it all up with a real-world case study happening in Milan that absolutely proves this tech has grown up. Let's start with that 2026 paradigm shift.
What's fascinating here is that the survival of a project now hinges solely on post-mint utility. If we look at the data tracking this transition from the early 2020s to today, the shift is stark.
Night and day.
We've moved away from tokens functioning as pure, standalone visual collectibles to tokens acting as foundational routing mechanisms.
The dialogue in the developer community is no longer about, generating a 10,000-piece profile picture collection and hoping the floor price doubles.
No, not at all. The engineering focus is entirely on utility. Provenance tracking, IP licensing, dynamic access control, anti-fraud ticketing, and token-gated digital environments that actually perform a necessary function.
Speculation hasn't vanished completely, of course. People still trade assets, digital art is still collected and flipped, but the baseline requirement to even be taken seriously in this space has changed.
It really has.
If a team launches a smart contract today and their only value proposition is, look at this cool artwork we generated, the market ignores them. They are dead on arrival. You have to answer that blunt question. Once this asset is minted and sitting in a user's wallet, what functional work does it perform?
To understand why that shift occurred, we really have to look at how engineers approach a proven concept. In 2021, the challenge was simply proving that digital scarcity could exist and be tracked.
And visual art was just the easiest way to test that.
Exactly, the easiest, most visually digestible way to test that boundary. But once the concept of digital ownership was proven cryptographically sound, the engineers and enterprise architects stepped in.
They took over the sandbox.
They did. They looked at the ledger and said, okay, we've proven we can definitively own a string of data. Now let's program that data to execute complex tasks.
It reminds me so much of the internet's trajectory in the late 90s. Back then, the web was this chaotic, neon-drenched place full of spinning globe GIFs.
Loud MIDI music playing in the background.
Yes, loud MIDI music, and companies just throwing the weirdest ideas at the wall to see what captured attention. It was entirely a novelty for most people. But eventually, the flashy, chaotic websites were replaced by hyper-functional, streamlined utilities.
It faded into the background.
Right. The internet became the invisible background infrastructure for global banking, logistics, and communication. We don't log on to surf the web anymore. We just use an app to order groceries, and the internet handles the API routing in the background.
Which is exactly the phase digital tokens have entered in 2026.
Yes.
The current enterprise applications mirror that trajectory perfectly. The protocols surviving today are the ones building those essential, boring utility layers.
The unsexy stuff.
Exactly, the unsexy stuff. They are the teams creating decentralized systems for managing commercial licensing rights or cryptographic supply chain tracking for physical luxury goods, or automated ticketing systems that integrate directly with major event venues.
I want you, the listener, to reflect on your own digital habits for a second. Think about how your perception of digital ownership has evolved over the last few years. Maybe you watched the 2021 craze from the sidelines, highly skeptical of the whole thing.
Which was completely fair.
Highly fair. But consider how comfortable you've become with the concept of a digital-only event ticket living in your phone's wallet, or a digital membership credential that unlocks a specific software tier.
You are already culturally primed to this infrastructure. You just might not have realized the back-end plumbing was changing.
So if the hype has died down but the back-end utility has skyrocketed, what does that actually look like in dollars and cents? Let's size up the 2026 market data.
The current market valuations paint a very compelling picture of industrialization, but they come with a major methodological caveat that we have to deconstruct.
Always a catch with the data. Let's look at the raw estimates first.
Okay, looking at the raw estimates, market intelligence firm Collection places the global market value of these digital assets at roughly $43.08 billion for the year 2025.
$43 billion.
And their projection pushes that figure to $60.82 billion by the end of 2026.
$60 billion is a staggering figure. That moves the conversation permanently out of the realm of a fringe hobbyist ecosystem and firmly into a massive industrialized macroeconomic sector.
It really does.
And looking at the Q1 2026 market commentary regarding Ethereum specifically, the trading volume is averaging about $720 million monthly. That's nearly $750 million in value, moving across a single blockchain network every 30 days.
But beyond the raw volume, the most telling metric is the shift in the entities tracking this data. We are seeing a massive expansion in institutional and macro-level narrative.
From the big players.
Yes. Grayscale's 2026 digital asset outlook specifically highlights the dawn of the institutional era, and we are seeing groups like CoinDesk's consensus moving toward publishing broader adoption index metrics rather than simply tracking the floor prices of visual collections.
I want to pause on those numbers, though, because anytime we look at tech valuations, we have to look at the fine print. And the fine print here is practically flashing in neon.
It always is with decentralized tech.
Every piece of journalistic and SEO-driven reporting on these valuations includes a mandatory caveat. It usually says something like, estimates vary by source and what they classify as an NFT transaction.
Right.
Why is the industry still struggling to standardize a simple market cap? Why can't a traditional financial analyst just look at an API feed and give us a definitive singular number for the whole market?
The discrepancy comes down entirely to tracking methodology and the fundamental nature of decentralized architecture.
How so?
Well, traditional stock markets operate on centralized, highly regulated exchanges. When a share of Apple stock changes hands, it happens within a closed, standardized reporting system.
It's easy to count.
Very easy. Digital assets, however, operate across dozens of disparate blockchains, hundreds of competing smart contract marketplaces, and direct peer-to-peer wallet transfers. The analytical blind spot is massive.
Give me an example of that blind spot.
Okay, if I move a digital asset from my cold storage vault to my mobile wallet, that registers on the blockchain as a transaction. Does a data aggregator count that as trading volume?
Even though no money changed hands.
Exactly. Furthermore, if a token is utilized strictly as a digital key to unlock a physical door at a co-working space, the smart contract registers a state change. Is that a financial transaction or just a data ping?
That distinction is crucial. If the technology has fundamentally shifted from speculative buying and selling to utilizing a token as a digital receipt or an API key, then trying to measure the total market size by looking solely at trading volume is looking through the wrong end of the telescope.
It's completely the wrong metric.
It would be like trying to measure the economic value of the global email protocol by calculating how much internet service providers charge for data packets. It misses the forest for the trees. It's infrastructure now, not just a commodity.
And that realization is exactly why institutions are pivoting to those adoption index-style reports. When a traditional financial powerhouse like Grayscale alters its reporting framework to measure adoption velocity rather than just speculative trading volume, it signals a definitive recategorization of the asset class.
They are attempting to measure the integration of the software layer into traditional business operations. They are treating it as foundational enterprise architecture.
Yes.
So for you listening right now, your critical thinking takeaway is to evaluate tech valuation headlines with an extremely skeptical eye. Whenever a publication screams about a multi-billion-dollar tech valuation in the Web3 space, equip yourself with the mental tool to immediately ask, what exactly is the methodology here?
What are they actually counting?
Are they measuring genuine economic transfer of value between two distinct parties, or are they scraping background data transfers and arbitrarily assigning a dollar value to system maintenance pings?
Developing that filter is a vital skill for navigating any emerging technology. Aggregate numbers provide us with broad trend lines and general market sentiment, but they are practically useless without understanding the specific parameters the analysts use to filter the on-chain noise.
Big institutional numbers and adoption indices sound very professional, but frankly, none of that matters if the architecture isn't actually solving friction for real people in the real world. Let's get out of the theoretical data and into the practical application.
Let's do it.
I want to look at exactly where this tech is operating right now in 2026. The research highlights 5 specific recurring use cases where digital utility meets physical reality. Let's take these one by one and really dig into the mechanics, starting with art provenance and digital certificates.
The concept of provenance has historically been a massive vulnerability in the fine art and collectibles market. For centuries, proving the authenticity and ownership history of a high-value physical asset relied entirely on easily forged paper certificates
Subjective expert appraisals.
and blind trust in centralized gallery archives. We are currently witnessing a migration from a system of trust me, to a system of verify it cryptographically.
Digital tokens are now the standard verifiable certificates tied directly to a work, whether that piece is a digital file or a physical oil painting. I want to look at how that actually works under the hood because it's not just a digital sticker that says this is authentic.
Far from it.
It operates as a highly secure dynamic data container. These tokens are programmed to permanently hold the specific edition data, the comprehensive exhibition history of the piece, and even a cryptographic hash of the artist's original statement or intent.
But the true strength, and the protocol developers are incredibly strict about this, is that the token must be inextricably linked to undeniable off-chain documentation.
The physical anchors.
Yes. We are talking about anchoring the token to high-resolution gigapixel scans of the physical canvas, digitized original purchase invoices, securely documented signature processes, and immutable custody transfer notes.
That anchoring process creates a mathematically immutable chain of custody. If a physical sculpture is sold to a new collector, the digital token representing its provenance is simultaneously transferred to the buyer's digital vault.
Anyone, anywhere in the world, can query the public ledger and instantly verify the entire chronological history of that piece.
They don't have to track down a gallery in Paris that might have closed a decade ago, or rely on a paper archive that could have been altered in a fire or forged by a sophisticated scammer. The real-world application here is the neutralization of the art forgery industry, at least for newly created works.
If a piece doesn't have its corresponding cryptographic history intact, the secondary market simply won't touch it.
Moving on to the second real-world use case, ticketing and access. This is arguably the implementation that affects the average consumer the most directly. We are looking at the systematic dismantling of ticket fraud and predatory scalping.
The live event industry has been fighting a losing battle against sophisticated scalping bots and counterfeit PDF tickets for decades.
It's been a nightmare.
The integration of token-gated access, where the ticket itself is a non-fungible digital asset, drastically alters the security landscape. It eliminates the counterfeiting vector entirely while simultaneously introducing programmable automation for the attendee's experience.
Think about the pure anxiety of buying a concert ticket on a secondary market website a few years ago. You show up at the venue, you're standing in line, and you have this knot in your stomach wondering if the barcode on your phone is actually going to stand.
Or if the scalper sold that exact same PDF to 50 different people who are also standing in line.
Exactly. When a ticket is tokenized on a decentralized ledger, that anxiety is mathematically eliminated. The scanning protocol cryptographically verifies the unique signature of the token in your wallet. It cannot be duplicated.
But the innovation goes so much deeper than just getting you through the turnstile.
Right. These smart contracts are programmed to trigger secondary benefits. VIP area access, dynamically timed entry slots to reduce queuing, and permanent proof of attendance digital collectibles.
The most disruptive element of tokenized ticketing, however, is the ability to encode business logic directly into the asset, where legally compliant event organizers can write smart contracts that dictate the rules of the secondary market.
That is massive.
An artist can program the ticket so that it fundamentally cannot be resold for more than 10% above its original face value, entirely breaking the business model of predatory scalping bots.
Or they can program it so that a set percentage of any secondary market sale automatically and instantly routes back to the venue or the performer. I want to paint a scenario for the listener to show how wild this is.
Go for it.
You buy a tokenized ticket to see your favorite band. The smart contract actively prevents a scalping syndicate from buying out the front row and marking the price up 500%. You attend the show, and upon scanning, the ticket's metadata dynamically updates to prove you were physically present.
It becomes a verified proof of attendance.
Yes. Then, maybe 2 years later, the band is launching a new tour. They can query the blockchain and say, anyone holding the attendance token from our 2026 show gets a 24-hour head start on buying tickets for the new tour.
Seamlessly transforming an admission ticket into an ongoing fan club membership.
And a backstage pass long after the physical event concluded, which serves as the perfect bridge into the third use case: memberships, patronage, and fan clubs.
The current industry terminology refers to this as the Patron 3.0 model. But what separates the 2026 iteration from previous attempts is a strict adherence to practical, deliverable utility.
It's the pragmatic fan club. The focus has shifted entirely away from promising world-changing ecosystems and toward delivering tangible, immediate value to a core group of supporters.
The current token-gated membership models focus on very specific, executable perks. Early access windows for physical merchandise drops, verifiable access to private Discord channels or studio update streams, unlocking private viewing rooms for digital content,
and allowing the community to vote on specific, low-stakes creative decisions.
I need to interject a massive warning here, however, regarding that community voting aspect. The current best practices strongly advise against overselling DAO governance unless the underlying mechanics are genuinely functional and legally structured.
DAO, for those familiar with the early Web3 space, stands for Decentralized Autonomous Organization.
Right. And in the previous market cycle, countless projects promised that holding a token granted the user voting rights to control the entire operational direction of a company or a massive treasury.
And we all watched those early DAO structures implode, didn't we? It turns out that managing a complex corporate entity by letting 10,000 anonymous internet users vote on highly nuanced legal strategy or budget allocations is a spectacular way to bankrupt a project.
It's a disaster.
Furthermore, most people realized they didn't actually want the fiduciary responsibility of managing a decentralized company. They just wanted a VIP pass to support an artist they admired.
So the 2026 mandate is absolute clarity and restricted scope. Keep the voting practical. Let the community vote on the colorway of the next limited edition sneaker drop. Do not ask them to vote on the LLC's tax strategy.
It is entirely an exercise in aligning expectations with functional reality. Moving to the fourth core use case, we encounter the highly complex world of licensing and royalties.
Yes, the royalties.
Here's where it gets really interesting, because the nuance surrounding royalties is the most misunderstood aspect of this entire technology. The prevailing narrative for years was that these tokens guaranteed creators a permanent cut of secondary sales forever, automatically.
The reality is far more complicated. Yes, smart contracts can brilliantly encode licensing terms and automate payment splits within a closed ecosystem.
So if a digital illustrator, a sound designer, and an animator collaborate on a piece, the contract can instantly and trustlessly route the funds 40-40-20 the millisecond a transaction clears.
That capability is revolutionary. But the critical blind spot that we have to be completely honest about is that cross-marketplace enforcement is historically broken.
The breakdown occurs at the protocol level, doesn't it?
It does, and it is a fascinating intersection of code and market economics. A smart contract inherently struggles to differentiate between a user simply transferring an asset between two wallets they own and a user selling that asset on a peer-to-peer exchange.
Right. To the contract, it just looks like the token moved.
Exactly.
Yeah.
Because of that technical limitation, the royalty enforcement relies on the secondary marketplaces voluntarily honoring the royalty flag in the token's metadata.
Voluntarily being the key word there.
Over the past few years, as marketplaces engaged in a brutal war for market share, many deliberately chose to ignore those royalty flags to offer buyers zero-fee trading environments. If the platform bypasses the function, the creator receives nothing.
So the key takeaway here is to strip away the illusion of a guaranteed magical money machine. Royalties function flawlessly when the creator, the smart contract, and the secondary marketplace are all actively aligned and supporting the standard.
It requires ecosystem participation, not just a line of code.
It's a sobering reality check for anyone who thought the technology alone could override human economic incentives.
If we connect this to the bigger picture, analyzing all these use cases, the immutable provenance, the anti-scalping ticket architecture, the pragmatic membership tiers, and even the ongoing technical battles over royalty enforcement standards, they all point toward the development of a unified theory of digital property rights.
The industry is painstakingly building the infrastructure to give creators verifiable control over distribution and to give consumers cryptographic proof of their purchases, which perfectly sets up the fifth and final real-world use case: brand collectibles that drive measurable real-world actions.
Major global brands are no longer minting tokens simply to issue a press release about being innovative. They're demanding highly measurable, closed-loop ROI.
The corporate integration strategies have matured significantly. Brands are utilizing these assets as dynamic connective tissue between their digital marketing and physical retail footprints.
They are deploying tokens to incentivize highly specific consumer actions: authenticated email acquisition, gamified loyalty point redemption mechanics, and secure claims for exclusive physical products.
It is the ultimate modernization of the cardboard punch card at your local coffee shop. But instead of collecting ink stamps, the consumer holds a dynamic, programmable digital asset.
Imagine a sportswear brand dropping a free digital collectible to anyone who downloads their new fitness app. Simply holding that cryptographic token in the app's wallet automatically applies a 15% discount code at the online checkout.
And if the user logs 50 miles of running in the app, the token's metadata visually upgrades, which then triggers an API call that allows the user to claim a physical, limited edition jacket that cannot be purchased anywhere else.
It's a highly interactive, hyper-gamified loyalty program that operates entirely via back-end smart contracts without the user ever realizing they're interacting with a blockchain.
That concept of invisible back-end integration is the absolute crux of why this technology is finally gaining mainstream traction in 2026. Let's lean into that, because those 5 use cases sound phenomenal in a vacuum.
They do.
They theoretically solve massive legacy problems in ticketing, art authentication, and brand loyalty, but it begs a massive, glaring question. If this architecture is such a silver bullet, why isn't every single local business and consumer utilizing it effortlessly today? Where is the disconnect?
The answer is the UX problem. The user experience of Web3 has, until very recently, been an absolute disaster.
To say interacting with early blockchain applications was a high-friction experience is a profound understatement. It was actively hostile to the average user.
Completely hostile.
Let's analyze what is actually cool in Web3 engineering right now. And by cool, I mean the unglamorous back-end developments that are finally slaughtering this friction. We're tracking 3 major trends. The first, and without question the most critical for mass adoption, is account abstraction and smoother onboarding.
To truly grasp why account abstraction is viewed as the holy grail by network architects, we have to look at the psychological barrier it dismantles.
The self-custody wallet.
Yes, for the first decade of this technology, the absolute largest bottleneck to adoption was the self-custody wallet. To even begin interacting with a decentralized application, a normal internet user had to download a highly technical cryptographic wallet extension.
Then they had to write down a 12 or 24-word generated seed phrase on a physical piece of paper.
Secure that paper like a birth certificate, and then navigate a complex centralized exchange just to purchase native cryptocurrency to pay the network gas fees required to execute a simple contract interaction.
I want to highlight how absurd that process was by comparing it to Web 2. Imagine if, to buy a pair of shoes on Amazon, you first had to download a separate security protocol, write down a 24-word cryptographic master password, navigate to a currency exchange to buy Amazon server tokens.
Transfer those tokens back to your browser.
Yes, and then pay a fluctuating microtransaction fee just to click the Add to Cart button. It's lunacy. Anyone who wasn't a hardcore tech enthusiast simply gave up.
Of course they did.
I tried walking a relative through buying a tokenized event ticket a few years ago. It took 2 hours, 3 different apps, and an incredible amount of frustration. That onboarding friction is exactly what stops a curious consumer from becoming an active participant.
That is precisely why this shift toward account abstraction fundamentally changes the trajectory of the industry. The engineering focus is now on radical simplification.
We are seeing the mass deployment of embedded wallets, the utilization of device-level passkeys, and a user interface standard where an individual simply clicks sign in like a normal app.
It is a total paradigm shift for the user. You authenticate using your standard email address, your phone's Face ID, or a Google single sign-on.
The complex, terrifying cryptographic wallet architecture is generated and managed entirely in the background secure enclave. The user never sees a seed phrase.
Furthermore, the concept of the user paying gas fees is being abstracted away via paymaster contracts.
Which is huge. The application developer or the brand covers the network transaction costs on behalf of the user, exactly the same way a Web 2 company pays Amazon Web Services for their server hosting, rather than charging the user a micro fee every time they click a hyperlink.
Web 3 is finally, desperately catching up to the frictionless standards of Web 2. It is the necessary process of hiding the wiring. A driver doesn't need to understand the thermodynamic principles of a combustion engine to operate a vehicle.
And a consumer shouldn't need to understand elliptic curve cryptography to scan a digital consult ticket. The second major trend we are tracking is deeply intertwined with this improved UX: the deliberate rebranding and tokenization beyond visual JPEGs.
This is a fascinating psychological pivot by the industry. The engineering community is increasingly framing these assets not as NFTs, but simply as data containers with programmed permissions.
They're actively stripping away the cultural baggage of the 2021 speculative hype cycle.
It is a highly effective strategy. When you approach a traditional enterprise architect and pitch an NFT integration, their immediate mental association is expensive, volatile cartoon avatars, and they dismiss the proposal.
But when you pitch the exact same technological architecture as a secure data container with dynamic permissions, they instantly grasp the utility.
They recognize it as a robust, tamper-proof database entry capable of holding authenticity claims, complex access routing rules, encrypted content unlocks, and transferable corporate memberships.
By reframing the terminology, the industry allows traditional software developers to embrace the underlying decentralized architecture without the reputational stigma. It's just a highly secure, programmable digital wrapper for whatever data payload you need to transmit.
The third major trend we are seeing focuses on infrastructure selection, specifically the integration of green and sustainability narratives.
We must approach this topic with intense analytical rigor. The early iterations of blockchain technology, particularly those reliant on intensive proof-of-work consensus mechanisms, possessed a notoriously massive energy footprint.
The contemporary analytical framework demands precision here. We are seeing specific blockchains and entire Layer 2 ecosystems aggressively positioning themselves as carbon-mitigated or structurally lower energy alternatives.
But the research guidelines flash a massive warning sign regarding how we discuss this. We cannot make broad, absolute claims. You cannot simply state that the technology is totally green now because the infrastructure is incredibly fragmented.
The accurate, data-backed phrasing is that development teams and corporate brands now actively factor energy consumption metrics and corporate sustainability commitments into their chain selection process, weighing those variables alongside transaction throughput, security, and gas fees.
It demonstrates a significant maturation in corporate governance within the space. Major brands are no longer selecting an infrastructure provider based simply on which network has the most retail hype.
They are conducting rigorous technical audits, evaluating the energy footprint, the cryptographic security models, and the long-term scalability as standard vendor requirements.
So if the UX friction is finally being neutralized via account abstraction and enterprise architects are treating these tools as pragmatic data containers, how does an individual actually deploy this right now?
The practical playbook.
Yes, if you are a digital creator, an independent artist, or a small business owner listening to this, and you want to integrate this architecture, what is the exact step-by-step playbook? We have a highly actionable, non-speculative creator checklist compiled from the latest market strategies. Let's break it down.
The first step is foundational and requires strict discipline. Decide the core purpose of the asset. As we've established, the era of minting a visual asset without a use case and hoping for a speculative bid is over. You must clearly define the utility container before you write a single line of code.
Is this asset functioning strictly as a certificate of authenticity for a physical sculpture? Is it a digital twin that grants the holder unlockable behind-the-scenes video content? Or is it fundamentally a membership access token designed to gate a private community forum?
You have to identify the exact problem you're attempting to solve before you build the tool. Once that core purpose is locked in, the second step is to choose your edition strategy.
I find this fascinating because it's less about technology and almost entirely about the psychology of digital scarcity, perceived value, and audience management.
The frameworks generally break this down into three distinct options. The first is the one of one. This is absolute, unyielding scarcity. It mimics the traditional fine art model, there is only one original, and it commands a premium based on exclusivity.
The second option is the limited small edition. This is utilized primarily for accessibility and community building. An artist might mint a specific piece as an edition of 50 or 100.
It allows a larger segment of their dedicated fan base to participate and hold the asset without completely saturating the market and diluting the perceived scarcity.
The third option, however, requires extreme caution, the open edition. I was looking at the warnings attached to open editions in the Creator Playbook, and they are severe. They explicitly advise against running an open edition unless the creator possesses a massive, highly optimized marketing funnel. Why is an open edition so potentially damaging for a smaller creator?
The danger lies in the psychological dynamics of supply and demand. An open edition allows an unlimited number of people to purchase the asset within a specific, usually short time window.
Right.
If a globally recognized artist with millions of highly engaged followers launches an open edition, it can be phenomenally successful, generating massive revenue while allowing every single fan to participate.
But if an emerging creator without that established audience funnel attempts an open edition, the results are often disastrous.
If the mint window closes and only 4 tokens were purchased, the public ledger permanently broadcasts a lack of demand. It completely strips away the urgency and the perceived scarcity that drives initial collector interest, potentially damaging the creator's brand permanently.
So what does this all mean? It means a creator has to conduct a brutally honest audit of their own audience size and engagement metrics before deciding how many assets to deploy. Moving to step 3 on the playbook, prepare buyer-friendly proof.
This directly ties back to our earlier analysis of provenance and data anchoring. A token is only as valuable as the verifiable data it points to.
Creators must assemble a comprehensive package of high-resolution imagery, detailed video process shots proving the creation of the work, and most critically, a legally binding description of rights.
That legal wrapper is the stumbling block for so many projects. You have to explicitly define the boundaries of ownership. If a collector purchases your digital asset, what exactly are they buying?
Are they acquiring strictly personal display rights to view the image on their devices, or are you granting them full commercial IP rights to print that image on a line of apparel and monetize it?
The creator must hard-code those definitions into the documentation tied to the smart contract to prevent future legal friction. Step 4 is picking your distribution channel.
The current distribution models offer various paths, highly curated boutique drops, open marketplace listings, or integrating with specialized partner platforms.
The strategic mandate here is to prioritize where your specific audience already aggregates. A creator should never force their community to navigate an entirely new, unfamiliar ecosystem if those collectors are already comfortable executing transactions on a specific platform. Reduce the friction by meeting the audience where they are.
Which brings us to the fifth step, and honestly, the step that determines whether a project survives past its first month plan post-mint value. The guidelines are incredibly strict here. They demand that creators provide consistent updates, detailed studio notes, and private previews.
But the absolute golden rule is to avoid vague promises and commit to a hard calendar-based plan. This specific mandate is a direct evolutionary response to the rug pulls and abandoned roadmaps that plagued the early 2020s.
During the speculative bubble, anonymous teams would publish massive, highly ambiguous roadmaps promising the eventual delivery of AAA video games, animated television series, and sprawling metaverse architectures.
And once the initial mint revenue was secured, the teams would inevitably fail to deliver on those impossible promises and abandon the project entirely.
It was an era of pure fantasy. Buy my pixelated owl today, and next year we'll have a multi-million-dollar theme park.
Exactly.
The 2026 playbook demands rigorous, boring accountability. Don't promise a theme park. Promise a high-quality, behind-the-scenes studio update stream on the first Tuesday of every month. Promise a private digital viewing room for token holders that will unlock specifically on November 15th.
Deliver a realistic, calendar-based schedule and execute it flawlessly. That shift in behavior is what transforms a speculative artist into a reliable, long-term digital entrepreneur.
It is the methodical establishment of trust over time. Now, analyzing these frameworks in theory is valuable, but examining a flawless execution of these principles in reality is where the true insights are found. We have a concrete, real-world case study currently operating in 2026 that perfectly bridges the gap between traditional physical institutions and seamless digital infrastructure.
Let's examine the Premio Michel C 2026, the Michel C Prize. The research highlights this specific event as the gold standard for blending an offline, physical credibility anchor with frictionless Web3 integration.
Let's look at the baseline mechanics first. This is a highly respected art prize designed for emerging artists. The barrier to entry is extremely low. Participation is completely free, and the selected artists are only responsible for the shipping costs of their physical works. The eligibility window targets creators between the ages of 18 and 40, with a submission deadline of June 15, 2026.
The traditional, physical components of the prize are robust and highly desirable for an emerging artist. The structure includes a €4,500 financial award for the first-place winner, inclusion in prestigious art publications, and significant exhibition benefits.
The core physical event is a curated exhibition taking place in Milan at the Ex Forniscola, running from September 12th to the 20th, 2026.
If we stop right there, this sounds exactly like a standard, highly prestigious legacy art competition. You have a physical gallery space in Milan, financial awards, and validation from a recognized cultural institution.
But here is where the 2026 infrastructure paradigm completely elevates the model. The Web3 integration layer.
The organizers have structured the prize so that the 12 selected finalists have the opportunity to digitize their physical works into authenticated digital assets, completely free of charge. This is facilitated by a specialized technical partner named Hoken.
This perfectly illustrates the account abstraction and friction removal concepts we broke down earlier. The participating artists do not have to learn how to write Solidity smart contracts. They do not have to manage seed phrases, calculate gas limits, or navigate decentralized exchanges.
Hoken, acting as the back-end infrastructure provider, completely abstracts the complexity. They handle the cryptographic anchoring, and the artist simply receives the immense benefit of possessing a verifiable digital certificate and a permanent on-chain record of their exhibition.
This raises an important question. Why is this specific hybrid model proving to be so highly effective in 2026?
From an analytical standpoint, it succeeds because it perfectly balances the real-world validation that traditional collectors require with the digital scalability that modern artists need.
It's an impenetrable bridge between the two worlds. The offline credibility anchor is the physical exhibition in Milan. That traditional gallery setting proves the art exists in the physical realm, the artist is a verified individual, and a respected institution has validated their technical skill.
But by pairing that physical validation with the digital infrastructure provided by Hoken, the artist instantaneously expands their reach from a single room in Italy to a global, verifiable market.
A collector sitting in an office in Tokyo who cannot physically attend the Milan exhibition can query the blockchain, instantly verify the piece's exhibition history, confirm its provenance, and potentially acquire the digital twin or the physical canvas with absolute cryptographic confidence.
It perfectly encapsulates the maturation of the digital asset space. The token itself is no longer the center of attention. It has rightfully taken its place as a highly secure, supportive technical layer that enhances a real-world event.
It provides cryptographic security, global market reach, and immutable provenance tracking without ever overshadowing the physical art itself.
As this model proves its efficacy, legacy art institutions and galleries will be forced to adapt their operational models to incorporate hybrid infrastructure like this, or they will rapidly lose market share to platforms that offer superior global provenance tracking.
If you are listening to this and you know any emerging artists, or if you are one yourself, you need to study how this hybrid architecture functions. This is the new baseline for professional portfolio building. The days of relying on a static PDF resume and a vulnerable personal website are ending.
The future belongs to creators who possess an immutable, cryptographically secured history of their exhibitions, paired with verified digital twins of their physical creations. It is an incredibly empowering system now that the technical friction has finally been abstracted away.
That concept, the abstraction of friction and the quiet integration of complex cryptography into the background of everyday operations, is the defining thesis of everything we have analyzed today.
It absolutely is.
Let's do a quick, high-level recap of the analytical journey we've taken today. We began by establishing the complete paradigm shift, moving aggressively away from the speculative profile picture casino era of 2021 and landing firmly in the infrastructure-first reality of 2026.
We analyzed a market approaching a $60 billion valuation, while equipping you with the critical thinking skills to evaluate the exact methodologies behind institutional adoption indices.
We systematically deconstructed the 5 tangible use cases that are currently driving enterprise adoption: immutable art provenance, programmable anti-fraud ticketing architecture, pragmatic community memberships, the complex realities of cross-platform royalty enforcement, and highly measurable brand loyalty integrations.
We also examined how account abstraction, through embedded wallets and sponsored gas, is quietly executing the death of the clunky crypto wallet, replacing it with frictionless user experiences.
We analyze the psychological mechanics of the creator playbook, emphasizing the absolute necessity of defined utility and calendar-based execution over the vague, empty promises of the past.
And finally, we saw all of these theoretical concepts executed flawlessly in the physical world via the Michelle C. Prize in Milan, proving that blending traditional institutional credibility with abstracted Web3 back-end tech is the current standard for success.
By understanding the underlying mechanics, by learning to see these tokens simply as highly secure, programmable data containers, you, the learner, are now fully equipped to filter out the lingering market noise and clearly understand how digital ownership infrastructure actually functions today.
True analytical power comes from understanding the foundational mechanics operating beneath the surface of the user interface. That knowledge allows you to recognize structural patterns in emerging technologies long before they become universally adopted.
I want to leave you with one final, highly provocative thought to process as you navigate the digital landscape this week. We have spent this entire deep dive discussing how this powerful, decentralized architecture is rapidly becoming seamless, invisible background infrastructure. It is currently hiding behind embedded application wallets, Face ID prompts, and simple email logins. If these programmable data containers are increasingly hidden behind the scenes, seamlessly integrated into our daily digital interactions, will we soon reach a point where the term NFT completely vanishes from our vocabulary?
Given the historical trajectory of foundational internet protocols, it is a highly probable outcome.
Think about your daily internet usage. When you open your web browser to read an article, you never say, "I'm going to render an HTML document transmitted via HTTP protocols." You just say, "I'm going to a website."
The technology is invisible.
Will we soon reach a point where we stop talking about digital assets or tokens entirely and simply refer to them as our concert tickets, our gym memberships, and our digital receipts? And if the terminology completely dissolves into everyday language, what happens to the distinct culture of Web3 when the underlying technology finally achieves total invisible ubiquity? It is a fascinating transition to watch unfold. Thank you for dedicating your time and focus to joining us on this deep dive.
Keep questioning the data, always evaluate the underlying mechanics, and we will see you next time.